Good morning, friends. My name is Kolajivel, Chartered Accountant, Company Secretary, Cost Accountant, Law Graduate, basically postgraduate in Commerce. We are going to discuss about contract costing today. I will read out the problem and explain the concept. Then we can work out the problem. GVL Limited commenced a contract on 1st April 2018. The total contract was for rupees 1,08,50,000. It was decided to estimate the total profit and to take to the credit of costing P&L account the proportion of estimated profit on cash basis which were completed back to the total contract. Actual expenditure in 2018-19 and the estimated expenditure in 2019-20 are given below. 2018-19 actual figure, 2019-20 estimated figure. Material issued 18,24,000, 32,56,000. Labor paid 12,20,000, 15,20,000. Outstanding at the end 96,000 and 1,50,000. Plant purchased 9 lakh and estimated column nil. Expenses paid rupees 4 lakh and 7 lakh. Outstanding at the end for actual nil and estimated is rupees 1 lakh. Prepaid at the end actual is 90,000 and estimated is nil. Planned return to store historical stores rupees 3 lakh and 6 lakh on 30th September 2019. Material at site rupees 1,20,000 and 3 lakhs. Work in progress certified is 51 lakhs and full. Work in progress uncertified is 1,60,000 nil. Cash received is 40 lakhs and full. The plant is subject to annual depreciation at the rate of 20% of written down value cost. The contract is likely to be completed on 30th September 2019. You are required to prepare the contract account for the year 2018-19 and estimate the profit for the contract. All the data is given. For actual expenditure is given and estimated expenditure is given. So there are two questions is asked. We have to prepare the contract account for the year 2018-19 and we have to estimate the total profit for the entire period. There are two questions. We have to prepare the contract account for 18-19 for 12 months period and estimate the total profit of the contract. The contract is going to end on 30th September 2019. So the number of months is 18 months. So GVL Limited is commencing its contract on 1st April 2018 and ends with 30th September 2019. The number of months from April 2018 to 30th September 2019 is 18 months. We have to work actual contract for 2018-19 for 12 months period and estimate the total profit for 18 months period. Actual expenditure is given in the problem for 12 months period. Up to September for 6 month period, there is estimated expenditure is also given in the problem. The total contract is rupees 1,08,50,000. That is also given in the problem. With respect to plant, depreciation calculation is also given in the problem. So based on the data given in the problem, we have to work out and compute the total notional profit for the period of 2018-19 and estimated profit for the entire period is the concept. Now we can work out the problem. Put the heading. We have to open a contract account. Just like ledger account, we have to open on the top right GVL Limited contract account. Open the bracket April 1st 2018 to 31st March 2019. So the contract is running from April 2018 to 30th September 2019, but the actual expenditure is given for the first 12 months period. So we have to work out a contract account for 12 months period alone. Then we have to move for estimated profit. So open contract account, put the debit and credit column. On the debit column, there should be two columns. The first column should be particulars and second column should be rupees column. On the credit side, particulars column and rupees column. So always you have to write particulars, rupees, debit, credit, particulars, rupees. Why? Because we are student, we should be very careful. All the expenditure is given in the problem. One by one we have to write. Go to debit side. The first expenditure given in the problem is material issued. Now we are talking about only actual expenditure. So go to debit side. Write to material issued. It is expense to contract company. So go to debit side. Write to material issued. It is given in the problem 18,24,000. Update in the outer column of debit side 18,24,000. Then the next expenditure is labor. So to labor. Go to inner column. Write to labor paid 12,20,000. Add outstanding at the end. Add outstanding at the end on the debit side. Write 96,000. Add 12,20,000 with 96,000 and update in the outer column 13,16,000. Why we have to add outstanding expenditure? Why? Because the outstanding expenditure as on 31st March 2019 is related with this period should be considered as expense. That is the reason why it is added. Whether it is paid or not, it is immaterial. Whether it is incurred or not is a material. So it is incurred in the period, it should be recorded in the period itself is the concept. So to labor 2,20,000, add outstanding expenditure 96,000, go to outer column, update 13,16,000. Then the next information planned purchase is given in the problem is 9 lakhs. There are two methods is available for this treatment. The first method, you can straight away update opening balance of plant on the debit side, update closing balance as on 31st March 2019 on the credit side. So the net effect will be given by way of providing debit of opening balance on the debit side and the credit side in the form of depreciation. The second method, instead of writing opening balance on the debit side and the closing balance on the credit side, we can calculate a depreciation for the period and update on the debit side by way of to depreciation. Here I am following the first method. So go to debit side, write to plant purchased rupees 9 lakh. Then the next information expense. Expense paid is rupees 4 lakh. Outstanding expense for the period is nil. Prepaid expense is rupees 90,000. So the expense is paid today, but the expense related to the forthcoming period should not be considered as expense for this period. That is the reason why it should be deducted. So out of 4 lakh, prepaid expense of rupees 90,000 to be deducted. 4 lakh minus 90,000 on the outer column write 3,10,000. Prepaid expense is related with other period, should not be considered as an expense for this period, so that it is deducted. Update in the outer column 3,10,000. Then next expenditure, planned return to stores is rupees 2,40,000. Planned return to stores rupees 3 lakhs. It is given in historical cost. That means the original cost it is given. So put to working note. The heading should be value of the plant returned to store as on 31st March 2019. Under that, historical cost of the plant returned is rupees 3 lakhs. Less depreciation at the rate of 20% of written down value for the year. So on 3 lakhs, we have to calculate depreciation 20% for 1 year. So 3 lakhs into 20% is what? 60,000. So 3 lakhs minus 60,000. The resulting figure will be 2,40,000. Then go to contract account, go to credit side, particulars, by plan return to stores, rupees 2,40,000 on the outer column. Within bracket, write working note 1. Why? It is indication to examiner stating that plant return to stores is rupees 3 lakhs. It is given in historical cost. So we have to provide depreciation at the rate of 20%. After providing depreciation, the written down value as on 31st March 2019 is only 2,40,000. So if you put within bracket working note 1, automatically the examiner will go and check working note 1 and you will be rewarded marks. So working note is also forming part of our answer. Next information given in the problem is material at site. How much? 1,20,000. So go to credit side. Under particulars, write buy material at site rupees 1,20,000. Then next information is work in progress. Work in progress may be work certified or work uncertified. Here both the things is given in the problem. So that go to credit side, write buy work in progress. Under that certified, inner column write 51 lakh. Under that uncertified 1,60,000. Add certified and uncertified, update in the outer column 52,60,000. Now what is the next information? The plant opening is taken. Whatever returned to store is also taken. Then the next information is balance plant. Balance plant. So buy plant at the site, that is a closing balance as on 31st March 2019 at the site. Buy plant, put to working note 2, then go to working note, write value of plant at site 31st March 2019. The historical cost of total plant is 9 lakh. Out of 9 lakh, 3 lakh value of plant was returned to stores already. So split the plant into two parts. 3 lakhs is one part and 6 lakh is one part. So 3 lakh part already considered and depreciation provided and taken to credit side of contract account. The remaining 6 lakh is available with us. For that we have to provide depreciation at the rate of 20% on written down value. Calculate depreciation 20% on 6 lakh. So 6 lakh into 20% is what? 1,20,000. So write depreciation is 1,20,000. So deduct depreciation from historical cost of rupees 6 lakh. The resulting figure would be written down value of plant at the site as on 31st March 2019. How much? 4,80,000. Update in the contract account credit side. Go to credit side, buy plant at the site. Within the bracket write working note to 4,80,000. So all the information given in the problem with respect to actual is considered. Now we have to add all the debit side. Add all the debit side. In the debit side 18,24,000, 13,16,000, 9 lakh and 3,10,000. The total expenditure on the debit side is rupees 43,50,000. Go to credit side, add all the amount 2,40,000 plus 1,20,000 plus 52,60,000 plus 4,80,000. The total figure is rupees 61 lakh. So whichever is higher, credit side is higher. Credit side is 61 lakh and debit side 43,50,000. Balance it. So the difference between 61 lakh and 43,50,000 is nothing but 17,50,000. Go to debit side, 17,50,000. It should be called as notional profit. Put the balancing figure within bracket BF to notional profit. Open the bracket BF balancing figure. Update 17,50,000. Notional profit is what? Is the next question. So notional profit is estimated profit for the particular period. Why? Because the contract is running to several months or several financial period. So we cannot wait and recognize the entire profit after completing the contract. So notionally we have to arrive the profit. Out of notional profit, based on work completion, we have to transfer the profit to profit and loss account. That is the reason why we are arriving notional profit here. So notional profit is nothing but here 17,50,000. Then next part of the question, we have to compute estimated profit for the entire period. That means is what? From April 2018 to 30th September 2019. 12 months plus 6 months, 18 months. So put a heading, GV Limited contract account, open the bracket, period 1st April 2018 to 30th September 2019. Under that, estimated profit. The heading should be estimated profit. Now we are going to compute the estimated profit for the entire period of 18 months. So contract account debit side, particulars and rupees, credit side particulars and rupees. For the 18 months period, we have to add all the expenditure on the debit side, actual plus estimated, and the credit side also we have to consider for 18 months period. So go to debit side, one by one we have to write the first expenditure given in the problem, material issued. Material issued for actually 18,24,000 and estimated is 32,56,000. Add 18,24,000 plus 32,56,000. Update in the outer column 50,80,000. Then 2 labor cost. Labor cost actual is given and estimated is also given. So open the bracket, add all the things. 2 labor cost 12,20,000 plus 96,000 plus 15,20,000 minus 96,000 plus 1,50,000. Why? Because 15,20,000 estimated expenditure of labor given in 2019-20 is also considering outstanding expenditure given in actual column. That is the reason why 96,000 is deducted. 96,000 actual expenditure is outstanding for the period of 2018-19 but paid in 2019-20. So it was paid in 2019-20 but expenditure incurred in 18-19. So at the time of incurring expenditure itself, it was considered. That means 96,000 was considered, so that it is deducted from 15,20,000. On the bottom you can write labor paid in 2019-20 is rupees 15,20,000, which also contains labor outstanding at the end of the period of 31st March 2019 is rupees 96,000. Then the resulting figure would be 14,24,000. So the net total labor cost for the entire period is nothing but 28,90,000. 2 plant purchased. As it is, you have to write, already we have discussed 9 lakhs. Then the total expenditure given, total expenditure is 4 lakh. Prepaid expenditure is 90,000. So 4 lakh minus 90,000 is rupees 3,10,000 plus 7 lakh plus 90,000. Why 4 lakh minus 90,000? That means expenditure is paid but not related to this period. Expenditure incurred in the next period but it was paid in the previous financial period. That is the reason why it was deducted from 4 lakh and add with 7 lakhs. So the total expense is nothing but 4 lakh minus 90,000 is equal to 3,10,000. 7 lakh plus 90,000, 7 lakh 90,000. So outstanding expenditure on 30th September is rupees 1 lakh. That should also be considered. So add 3,10,000 plus 7 lakh 90,000 plus 1 lakh. Update in the outer column. Buy material at the site is rupees 3 lakhs. Go to credit side. Write buy material at the site rupees 3 lakh. Buy plant returned to stores as on 31st March 2019. Go to credit side. Buy plant returned to stores as on 31st March 2019. That means after considering depreciation, Write on the credit side 2,40,000. So there is two classification. Out of total plant 9 lakhs, 3 lakh was considered as a return to store. That is a historical cost. From historical cost, we have to provide depreciation. After providing depreciation of 60,000, then the resulting figure 2,40,000 should be updated on the outer column. Then the remaining balance is rupees 6 lakh historical cost. For that 6 lakh, we have to provide depreciation. Already we have arrived written down value of 4,80,000 as on 31st March 2019. Put to working note, value of plant written down value as on 31st March 2019 is rupees 4,80,000. From 4,80,000 we have to provide depreciation 20% for 6-month period. Calculate 4,80,000 into 20% divided by 2. Why 6-month period? Already 4,80,000 means after providing depreciation for 12 months period. So we have to take a written down value as on date. From that we have to deduct depreciation for 6-month period. That means 1st April 2019 to 30th September 2019. Go to outer column, update 4,32,000. Then the total contract was 1,08,50,000 should be taken on the credit side. Go to credit side, write by contractee account 1,08,50,000. Now we have to check whether debit is higher or credit is higher. Go to debit side, add all the amount 50,80,000, 28,90,000, 9 lakh and 12 lakhs. The total amount of debit side is 1,70,000. Go to credit side, add all the rupees 3 lakh, 2,40,000, 4,32,000, 1,08,50,000. Total amount on the credit side would be 1,18,22,000. Whichever is higher, credit side is higher. So deduct 1,18,22,000 minus 1,70,000. The resulting figure would be called estimated profit of rupees 17,52,000. So go to debit side, write to estimated profit is 17,52,000. Within bracket, write BF, balancing figure. So we have learned what is a contract account, how contract account should be worked, and how notional profit should be calculated and estimated profit should be calculated. We can meet in next session. Thank you.